Have you ever wondered why some companies look too clean, too smooth, too perfect? Imagine you walk into a store. Clean floors, organized shelves, products neatly labeled, imported from halfway across the world. The owner is polite, the prices are reasonable. The business has been operating for years. Now imagine that none of it, not the products, not the storefront, not the invoices, represents what's actually happening with the money flowing through it. This isn't a thriller. This isn't a conspiracy theory. This is a documented financial phenomenon that regulators in the United States, the United Kingdom, Germany, and across the European Union have been quietly trying to understand and contain for decades. It's called trade-based money laundering, and the reason most people have never heard of it, despite it moving an estimated $800 billion to $2 trillion through the global economy every single year, is precisely because it looks so ordinary. Today, we're going to look at how it works, why it's so difficult to catch, and what it actually costs the rest of us, the people who earn honestly, pay taxes faithfully, and still wonder why the system always seems tilted just slightly out of reach. Let's start with a person. Let's call him Marcus. Marcus is 34 years old. He lives in the outskirts of Chicago. He works in supply chain logistics for a mid-size manufacturing company. He's good at his job. He understands how goods move across borders. He knows what freight forwarding means, what customs declarations look like, and roughly what a container of electronics from Southeast Asia should cost to import. Marcus earns around $72,000 a year before tax. After federal income tax, state tax, and Social Security deductions, he takes home approximately $52,000 annually, roughly $4,300 a month. His rent is $1,650. His car payment is $480 on a used sedan he financed 3 years ago. He has $23,000 in student loans from a business degree he completed in his late 20s. His monthly minimum on that loan is around $240. He has a credit card balance sitting at $4,800 that he's been slowly chipping away at for 2 years. After essentials, groceries, utilities, insurance, phone, Marcus has maybe $700 to $900 left each month. Some months more, some months considerably less. Marcus is not irresponsible. He's not reckless. He's doing what most working professionals in the United States and Western Europe are doing. He's working within a system and playing by its rules. Now, here's what's interesting. A few kilometers from where Marcus rents his apartment, there is an import-export business. Small warehouse, a modest office front. The business imports consumer goods, electronics, textiles, kitchenware, primarily from Asia and parts of Eastern Europe. It files its paperwork, it has invoices, it has a business bank account. On the surface, it looks entirely legitimate. But the financial flows inside that business don't quite match reality. And understanding why is where this story gets genuinely important. Let's define the problem clearly, because this is a topic that gets discussed in financial crime circles, but almost never reaches the general public, and it should. Trade-based money laundering, or TBML, as it's referred to in regulatory and enforcement communities, is the process of disguising illegally obtained money by moving it through international trade transactions. The core idea is straightforward. If you have money that cannot be explained, money that came from crime, from corruption, from tax evasion, from sanctions violations, you need it to give it a legitimate-looking origin. You need it to look like it came from business. And importing and exporting goods across international borders is one of the oldest and most effective ways to do exactly that. Here's a simplified version of how it works. Imagine a criminal organization has $10 million in cash that needs to appear legitimate. They set up or they partner with an import business. That business orders a shipment of goods, let's say electronic components, from a supplier overseas. The actual market value of those components is $2 million, but the invoice says $10 million. The business pays $10 million, the supplier receives $10 million. The criminal organization has now moved $8 million in dirty money across an international border, disguised as a trade payment. The paperwork exists, the goods physically exist, customs saw a shipment, the bank saw a wire transfer for imports. This is called over-invoicing. The reverse also works. Goods worth $10 million get invoiced at $2 million. The importer pays only $2 million on paper, but the actual $8 million difference is transferred through separate, informal channels. The exporter effectively receives $10 million total. Dirty money enters through the trade gap. This is under-invoicing. There are more sophisticated variations. Phantom shipments where goods never move at all, multiple invoicing of the same shipment, deliberate misclassification of goods to exploit different tariff rates. But the underlying mechanism is always the same. The gap between what an invoice says and what reality actually is becomes a channel for moving money. The Financial Action Task Force, the global body that coordinates anti-money laundering standards, has identified TBML as one of the 3 primary methods used by criminal organizations to launder money globally, alongside cash smuggling and traditional financial institution methods. And crucially, it is widely regarded as the hardest of the 3 to detect. This is where the story becomes genuinely uncomfortable, not because of anything dramatic, but because of how rational and mundane the difficulty actually is. International trade is enormous. The World Trade Organization estimates that global merchandise trade alone exceeds $24 trillion annually. Customs agencies in the United States, Germany, the Netherlands, France, and across every developed economy are processing millions of shipments, millions of invoices, and billions of individual line items every single year. Now consider that a customs officer examining a container declaration has to make a judgment about whether the stated value of a shipment is accurate. Is $180,000 for a container of textile goods reasonable? It depends on the fabric, the quantity, the country of origin, the specific market conditions that week. These are not simple determinations. They require specialized knowledge, real-time market data, and significant time, none of which exist in abundance at a busy port. The United States Customs and Border Protection processes over 35 million cargo containers entering the country annually. The Port of Rotterdam, Europe's largest, handles hundreds of millions of tons of goods every year. The sheer scale makes comprehensive verification mathematically impractical with existing resources. There's also a legal complexity. Trade transactions cross jurisdictions. A wire transfer goes from a business account in one country to a supplier in another. The goods move through a third country's port. The paperwork is filed in a fourth country's language. No single regulatory agency sees the full picture. Each one sees only its own piece. And here's what's rarely said plainly. The banking system, despite all of its compliance infrastructure, is not particularly well equipped to detect TBML either. Banks are trained to look for unusual cash transactions, large deposits, structuring, wire transfers to sanctioned countries. But a payment for an import invoice, that's exactly what an import business is supposed to do. The transaction looks precisely like legitimate commerce, because structurally it is commerce. The illegitimacy is buried in the pricing, and pricing verification is not a standard function of bank compliance. This is not an accusation against any specific institution. It's a structural reality that regulators themselves have openly acknowledged. Let's come back to Marcus. And let's talk about what this actually costs people like him, because this isn't an abstract regulatory problem. It has real, measurable economic consequences. The first cost is tax revenue. When a business deliberately misrepresents the value of goods to move money, customs duties are misrepresented. If goods worth $10 million are invoiced at $2 million, the tariffs paid are calculated on $2 million. The government, and by extension the public, loses the tariff revenue on the remaining $8 million. Scale that across the estimated volume of TBML globally, and the loss in customs revenue alone runs into the tens of billions of dollars annually across developed economies. That is money that doesn't go into infrastructure, that doesn't fund schools or transit systems or healthcare programs that working people depend on. The second cost is market distortion. When a business is laundering money through trade, its actual operating costs are structurally different from a legitimate competitor. It doesn't need to turn a profit in the traditional sense. The money laundering function itself is the primary purpose. This means it can price goods lower, absorb losses a legitimate business couldn't sustain, or undercut competitors in ways that have nothing to do with efficiency or quality. Think about what this means for the honest honest importer trying to compete, or for the domestic manufacturer already competing against lower-cost imports. The playing field isn't just uneven, it's operating under completely different rules that legitimate businesses don't even know exist. The third cost is systemic trust. Financial systems function because people believe they are operating on roughly consistent rules. When significant flows of criminal money move through the same trade infrastructure that honest businesses use, it corrodes the integrity of that infrastructure over time. It increases compliance costs for legitimate businesses because regulators respond by adding requirements and reporting burdens that fall most heavily on those who are actually trying to comply. Marcus is paying more in taxes, facing a more distorted consumer goods market, and working within a system that adds friction for honest participants, while sophisticated criminal actors navigated around it. He doesn't see this directly, but the effects are embedded in his economic reality.
There's a psychological dimension to why trade-based money laundering persists at the scale it does, and it's worth spending a moment on it because it says something important about how financial crime actually works in practice. Human beings are pattern recognition animals. We assess threat based on what we can see and categorize. A person walking out of a store with stolen goods registers as theft. It's visible, it's physical. It violates an intuition we have about property. But an invoice with a slightly inflated price on a freight shipment, that requires specialized knowledge, attention to invisible data, and an awareness that something might be wrong when everything looks procedurally correct. This is what makes white-collar financial crime structurally different from other forms of crime. The harm is real, but it's distributed invisibly across millions of people and thousands of transactions. No single person feels the wound. The damage accumulates in aggregate. Regulators have a term for this, the complexity of diffuse harm. When harm is concentrated, one person stealing from one victim, law enforcement responds efficiently. When harm is distributed, billions of dollars moving through trade channels with the cost absorbed across an entire economy, the response is slower, more bureaucratic, and often insufficient. This is not a cynical observation. It's simply an accurate description of how the detection and enforcement systems are built and what they are optimized for. The people who design TBML schemes understand this psychology very well. They understand that complexity is their shield. Every additional jurisdiction, every additional layer of documentation, every additional legitimate-looking transaction adds another degree of difficulty to any investigation. Now, let's shift perspective slightly, because this video isn't meant to be a portrait of helplessness. It's meant to be an honest look at a system, and once you see a system clearly, you can make more informed decisions within it. What does financial intelligence actually look like when applied to topics like this? It starts with understanding that the economy you participate in every day is not a simple, transparent machine. It is a layered, complex system in which different actors are operating under vastly different rules and incentives, some of which are never visible to you. A financially intelligent person doesn't respond to that with paranoia or cynicism. They respond with calibrated awareness. They understand that some of the price advantages they see in the market have explanations that aren't printed on the label. They understand that the playing field isn't always flat, not because of some abstract conspiracy, but because enforcement and detection systems have limits that sophisticated actors exploit. More practically, the financially intelligent person pays attention to regulatory developments in this space, not obsessively, but with the understanding that these are the kinds of systemic reforms that actually change economic conditions over time. The European Union's Anti-Money Laundering Authority, established as a centralized regulatory body with cross-border jurisdiction, represents a structural shift in how these crimes are pursued. The United States' FinCEN, the Financial Crimes Enforcement Network, has been expanding its beneficial ownership tracking requirements specifically to close the corporate opacity that TBML schemes rely on. These are slow-moving changes. They don't generate headlines, but they matter. The financially aware person also understands that the best personal financial decisions are still made in reference to long-term fundamentals, building genuine assets, reducing dependency on debt, and understanding the actual actual costs of the consumer economy they're operating in, rather than in reaction to system-level problems they cannot individually solve. Marcus, earning $52,000 take-home, has real financial constraints, but his awareness of why those constraints exist, partly structural, partly systemic, allows him to think more clearly about the choices that are genuinely within his control versus the forces that aren't. That distinction matters. Not every financial difficulty is a personal failure. Some of it is the cost of operating within a system that has significant unaddressed inefficiencies. So let's bring this back to where we started. A clean storefront, organized shelves, imported goods, neatly priced. Everything looks ordinary. The point of this video was never to make you distrust every business you walk into. That would be neither fair nor rational. The vast majority of import businesses operate honestly and competitively within the rules. The point was something quieter than that. It was to make visible a mechanism that moves an estimated $1 to $2 trillion annually through the global economy, a mechanism that is hidden not by darkness, but by the ordinary appearance of paperwork, invoices, and trade transactions. A mechanism that costs governments customs revenue, costs honest businesses competitive fairness, and costs working people something harder to quantify, but genuinely real. Financial literacy, in its fullest sense, isn't just about managing your own budget or choosing the right investment account. It's about understanding the system you're operating within, its design, its gaps, and the ways in which different actors navigate it differently. When you understand that, you're not just better at financial personal, you're a more informed participant in the economic and civic decisions that shape the conditions everyone lives under. Trade-based money laundering isn't a niche topic for regulators and compliance officers. It's a window into how financial systems actually function and who they actually serve when the paperwork all looks exactly right. That's worth understanding. Subscribe.